走进纽交所，直击华尔街。今年上半年，华尔街风起云涌，受到芯片及人工智能板块的提振，美股主要股指在经济可能陷入衰退的阴影下屡创新高。3月份爆发的银行危机中，多个地区性银行倒闭，这引发了银行板块的一系列动荡。那么到目前为止，危机是否已经结束？华尔街金融巨头近期再现裁员大潮，2008年金融危机是否会有可能再度上演？与此同时，美联储连续多次加息以对抗通胀，但美国的通胀依旧远高于目标水平。在6月份维持利率不变的决策之后，美联储下半年是否还会重启加息？利率环境大变，2年期与10年期美债收益率曲线多次出现倒挂的情况，美国经济是否面临着硬着陆的风险？6月30日，我们邀请到牛津经济研究院的首席美国经济学家 Ryan Sweet，对下半年美国宏观经济进行展望，并且谈一谈他对于美联储加息路径的研判。牛津经济研究院是全球知名的独立经济预测及量化分析机构，自1981年从牛津大学商学院起源，至今已经有近40年的历史。Ryan Sweet 主要的研究方向包括预测和评估美国宏观经济前景及其如何影响货币政策和金融市场。他曾经被美国财经媒体 Market Watch 和彭博社誉为最精确的美国经济高频预测者之一。Ryan 你好。
Thank you for having me.
After raising interest rates 10 times in a row to fight inflation, the Fed chose to keep interest rates unchanged in June. But Fed Chairman Powell recently said the interest rate increases are likely ahead as inflation is still well above. What do you think of the Fed's rate hike path in the second half of the year?
Our baseline forecast, which is roughly in the middle of the distribution, there's a lot of different potential outcomes, but most likely is that the Fed we're going to call their bluff in the sense that they paused in June to assess past tightening in monetary policy and to see what the effects on inflation, the unemployment rate is. A 1 month pause doesn't really make a lot of sense. Like you only get a few data points. So I think the Fed is most likely going to pause through the rest of the year, even though I would say that the risks are heavily weighted towards them raising rates at least one more time. And in the end, it's most likely going to be because the Fed is going to kill something. They're going to kill the economy, they're going to kill inflation, and most likely they're going to kill both.
How do you interpret the current inflationary pressures? Which sectors are more sticky to inflation? Do you think it is possible for US inflation to fall back to the Fed's 2% target? When will it happen?
That's a great question. Inflation will return back to the Fed's target because, again, getting back to the idea that the Fed's going to err on the side of doing too much too quickly in an effort to bring inflation back down. It took a pandemic to bring inflation back to the U.S. In my 18 years as a business economist, inflation has at least generally been below the Fed's 2% target. Took a pandemic, supply chain stress, Russia's invasion of Ukraine, a sudden jump in energy prices. That really brought back inflation, at least temporarily, in the U.S. Our inflation problems this year are more driven by the labor market. The labor market's very tight. Nominal wage growth in the U.S. is very strong, and that's pulling up prices for a lot of services. Whereas last year, it was supply constraint issues, which the Fed could not directly address. This year, the Fed can address, the inflation issues that are attributed to the strength of the labor market, and that's why, in the end, if I'm wrong, and the Fed resumes raising interest rates, it's going to be because they want to make sure that they really choke off services inflation.
Which sectors are most sticky to inflation?
Housing's the biggest issue right now. The good news when it comes to housing, and which includes both owner's equivalent rent, but also tenant's rent, is that market rents have rolled over, and that typically, they rolled over this time last year, and it takes about 12 months before they start to show up in the consumer price index, personal consumption expenditure deflator. So we're going to start to see a lot of relief on the rental side of things in the second half of this year, and that's why I think in the end, the Fed's most likely talking the talk and not going to walk the walk when it comes to rate hikes.
The Federal Reserve has a dual mandate of promoting maximum employment and maintaining stable prices. How do you think the Federal Reserve balances these objectives, particularly during times of economic uncertainty? And what challenges does it face in achieving both goals at the same time? Do you think the Fed's monetary policy is sufficient to control inflation?
Yeah, the Fed's got all the tools that they need to bring down inflation. And that's why, our forecast is for them to bring back down inflation to their 2% target, not by, next month or the end of this year, most likely by the end of next year. But they have a very blunt instrument, which is the Fed funds rate, raising interest rates, that typically slows the economy, brings down nominal wage growth, pushes the unemployment rate higher, and that by extension will help lower inflation. But I'm very confident, the Fed's credibility has not been tested. I think the Fed's credibility is still very, very strong as an inflation fighter. But at the same time, we're still far from, achieving their dual mandate of full employment. The unemployment rate in the US is still 3.7%, which is historically very, very low. But at the same time, we have inflation that's well above the Fed's target.
As one of the most reliable indicators for the bond market to measure recession fears, yield curve inversions between 10-year and 2-year rates reaches 100 basis points many times, sending a pessimistic signal about the US economic outlook. But the US economy has not yet entered a recession yet. Some believe that the US economy will not fall into recession in 2023. Is it too early to judge?
Yeah, forecasting a recession is a humbling experience in the sense that, anytime when you're forecasting a $25, $30 trillion economy, humility is very, very important because there's a lot of moving parts and there's no single metric that is perfect at predicting recessions, even the yield curve. In fact, I'm a yield curve skeptic in the sense that I don't think the yield curve today is sending as strong as a signal of a recession that it has in the past. But in the end, if you look at, kind of reading the tea leaves of all the economic data, my favorite economic indicator is initial claims for unemployment insurance benefits. These are the number of people that are filing for unemployment insurance benefits, not necessarily the number of people that are receiving them, it's just the number of people that are filing. And when that rises, that's typically a bad omen for the economy. And we're starting to see some signs of, the trend moving higher in initial claims. Therefore, that psychological cycle will likely kick in soon. In the fact that when unemployment goes up, we see friends, family members getting laid off. What is the first thing we do? We run for the bunker. We cut back on spending, and that leads to more layoffs, and we go into this vicious cycle. So that's something I'm keeping very, very close attention to.
Why do you think employment insurance benefits are so important?
Unemployment insurance benefits. It comes out every Thursday, and it just measures the number of people that are filing for unemployment insurance benefits in the US. So typically, when we see the reemployment rate, so how quickly people are being laid off, how quickly are they finding new work? If that comes down, then we're going to see unemployment insurance benefits rise, the unemployment rate will increase, and then that kind of kicks in this psychological cycle that typically, sends us into a recession.
Looking ahead, what is your overall outlook for the US economy? Are there any key factors or risks that could shape the trajectory of economic growth and stability?
So I'll give you a few. First, we'll start with the pessimistic one. I'm worried about lending standards. So the recent stress in the banking system has caused banks to tighten, the screws on lending standards. So it's more difficult for businesses and consumers to get loans in the US, and that's going to weigh on economic activity in the second half of this year and into early next. Therefore, I think that's one reason why the recession is more likely than not. On top of that, you have the past tightening in monetary policy, the past tightening in financial market conditions. That's all going to hit the economy in the second half of this year. On a more optimistic note, there is still a path to a soft landing, and a soft landing is where the Fed returns inflation to their 2% target without pushing the economy into a recession. And that goes through inflation. If inflation comes down a lot faster than what we're anticipating, real disposable income in the US, and that's income after taxes, that's what matters for consumer spending. Therefore, if inflation comes down quickly, then people are going to have more spending power, and that's how we're going to engineer a soft landing. The other thing is, on the optimistic side, is that we have about $1 to $1.5 trillion in excess savings, and excess savings is just the additional amount of cash that consumers have relative to their pre-pandemic saving patterns. So this cash is either checking accounts, under their mattress, buried in the backyard, but that's a lot of firepower for the American consumer. The issue is, and one reason why we don't expect this to really prevent us from going into a recession, is that a lot of it is that excess savings is with high income households, and they're going to have a lower marginal propensity to consume. Therefore, they're going to treat this more as wealth than cash. Therefore, I don't think we're going to see a lot of that being spent out over the next couple of years.
What are your thoughts on the regional banking crisis associated with Silicon Valley Bank? Do you believe that the banking sector has adequately addressed and mitigated the associated risks? Additionally, in your viewpoint, what other variables or factors require attention to ensure overall stability in the banking sector?
Well, I think the banking system today, in aggregate, is much stronger than it was pre-financial crisis. Banks most banks have to go through, stress testing. The Federal Reserve just recently released their annual stress testing results and showed that, the banking system is sound, it's rock solid. I would describe this, recent stress as a panic, not a crisis. This isn't a Lehman moment. This is not, a financial crisis. The risk of contagion is much lower now than it was, pre-financial crisis. My wife, she hates this analogy, but I think it's pretty useful. When the Fed raises interest rates, it's like the tide going out. It exposes anyone that's not wearing a bathing suit. And we've recently seen that, there's, some cracks in the banking system. Not enormous cracks, but when the Fed raises interest rates, it's going to affect or expose any fissures in the broader economy and in the banking system. And there are pockets of weakness within the banking system, but overall, Tier 1 capital ratios are still very elevated. The stress testing shows that large banks mid to large size banks are in very good position. Therefore, I don't think this is going to turn from a panic into a crisis.
Financial institutions on Wall Street have recently set off a round of layoffs. Similar situations have also occurred in larger technology companies in Silicon Valley. At the same time, the US labor market stays strong from the economic data's perspective. Why do you think of this seemingly contradictory situation?
So let's break it up. First, with financial institutions, when higher interest rates with the yield curve that you alluded to earlier, when the yield curve is inverted, that throws the traditional banking model of borrowing short and lending long on its head. Therefore, you're going to see layoffs when refinancing activity for mortgages declines. Overall, banks are going to tighten lending standards. Therefore, they're going to need fewer employees. When it comes to tech, I think tech was at the forefront of the recent layoff announcements, but the unemployment rate among tech workers and the reemployment rate, meaning, if a tech worker gets laid off, how quickly are they going to find new work, is still really, really high. Therefore, that is limiting the increase in the number of people who are filing for unemployment insurance benefits. It's also limiting the rise in the unemployment rate. So overall, the strength of the overall labor market is still very, very strong. And that is, kind of creating this, disconnect between layoff announcements, which always don't translate into actual layoffs. So companies can announce, we're going to lay off X number of workers, but in the end, they may lay off a lot fewer. and between the actual number of layoffs that we're seeing in the economic data.
Financial crises, such as the one experienced in 2008, can amplify and prolong recessions. In light of this, what lessons have been learned from the past crises, and how can policymakers and regulators better safeguard against such events in the future?
Well, I think lawmakers and policymakers, including the Federal Reserve and other central banks, learned a big lesson from the financial crisis. So they put a lot of safeguards in place, including the stress testing, for example, that we just recently saw the results of. But two crises, two recessions, they're never the same. And I think that's something that's important to keep in mind, is that this upcoming recession, because the pandemic has not repealed the business cycle in the US, this recession is going to be different than the pandemic. It's going to be different than the financial crisis in a number of regards. First, housing is going to hold up a lot better. This is not, even though house prices in the US have gone through the roof, a lot of people are rate locked. I use myself as the poster child for this. So during the teeth of the pandemic, my wife and I, my wife found the house that she wanted, and she's been looking for in the school district. And we locked in a very low mortgage rate. So I told her when we were signing the mortgage payments, you're going to have to bury me in the backyard because we are never moving. And I think that's an issue that is applicable to a lot of people in the US, that people are not going to move, they're not going to trade up, and they're not going to trade down because they've locked in such a low mortgage rate. Other aspects of this recession that are going to be different is that the composition of layoffs are going to be different. It's going to be more concentrated among white-collar jobs versus blue-collar jobs because of labor supply constraints. But when it comes to just broader financial stability, I think the Federal Reserve lawmakers have put enough in place since the financial crisis to reduce the odds of another 2007, 2008, 2009 anytime soon. Doesn't mean it won't happen, but hopefully it doesn't happen in our lifetimes. Hopefully that was just once in a generation type event.